Warren Buffett, the Oracle of Omaha. For decades, he's been seen as the master of investing, turning Berkshire Hathaway into a massive success story and amassing one of the greatest fortunes in history. His approach is widely celebrated: invest in what you know, be patient, and focus on long-term value. But here's a truth most people miss: Buffett's strategy, as inspiring as it is, might not actually be practical for the average investor. In fact, trying to follow his path exactly could be more fantasy than reality. One major reason is Buffett's unique financial position. He's not just wealthy, he's one of the wealthiest people on the planet. When he invests, he's doing it with billions at his disposal, and that scale changes everything. Unlike typical investors who might be working with a few $1,000s, Buffett's capital allows him to buy massive stakes in companies, often giving him direct influence over management and business decisions. Think about it: if you could sit down with CEOs and impact the direction of a company, your investment risks would be very different. Buffett has the power to reshape the very companies he invests in, a privilege most of us will never have. So, while his returns are impressive, they're not replicable for someone who doesn't have that kind of access. And here's the key question: how realistic is it to expect similar outcomes without the same leverage? Buffett also has an unparalleled network, built over decades. When he invests, he's not just a shareholder, he's someone whose opinion is respected at the highest levels of finance. This gives him access to deals and information that average investors simply don't have. Imagine you're trying to follow Buffett's philosophy and looking to invest in a high-quality company. You'll be relying on publicly available data, news, and market reports, while Buffett has direct conversations with industry leaders, analysts, and executives. He doesn't rely on guesswork or second-hand analysis; he has the advantage of deep, first-hand insights. For the rest of us, even with research, we're at the mercy of what we're allowed to know, making it far easier to miss critical details or fall into common pitfalls. Without that inside perspective, the question is, can we really achieve Buffett-level success? Another thing to consider is Buffett's famous patience, which is often romanticized as the ultimate key to his success. The idea of buy and hold is a great one, but for most people, the reality of holding an investment long-term is filled with unexpected obstacles. Market conditions shift, financial needs change, and life can throw curveballs that require cashing out sooner than planned. Buffett's wealth allows him to ignore the short-term fluctuations because he doesn't rely on his investments to pay his bills or secure his retirement. For the average person, this luxury isn't an option. Life's uncertainties make it challenging to just sit and wait when your financial well-being is on the line. While Buffett can weather economic storms without selling, regular investors may not have the same security blanket. The question arises: can buy and hold really work for someone who doesn't have Buffett's financial resilience? Buffett's success is also rooted in a specific era of investing. He built his wealth during a time when information moved slower and markets were far less saturated with institutional players and algorithms. Today's market is fiercely competitive, with hedge funds, high-frequency trading, and AI-driven investment models all impacting prices in real time. This creates an environment where the traditional value investing approach can be harder to execute successfully. Buffett's strategy worked wonders in the past, but for today's average investor, it can be a different story. The market has changed, and clinging to strategies from a different era might put you at a disadvantage rather than leading to similar success. Then there's Buffett's discipline, often portrayed as a trait that anyone can emulate. He famously avoids speculative investments, preferring businesses with proven track records. But what's rarely discussed is how he's been able to stay focused because of his own unique psychology and circumstances. Most people aren't naturally wired to avoid emotional decisions, especially in volatile markets. Fear and greed can easily sway the average investor, leading to risky moves during market highs and panic during lows. Buffett's discipline is partly a result of decades of experience and confidence built from repeated success. For someone without that background, the path is much harder. Is it realistic to expect that everyone can follow his ironclad discipline, or is it setting people up for disappointment? Ultimately, while Warren Buffett's investment strategy offers valuable lessons in patience, discipline, and focusing on quality, it's essential to recognize that his path is uniquely his own. His unparalleled wealth, network, and market influence allow him to operate in a world that most people simply can't access. For the average investor, trying to mirror Buffett's moves without the same resources or privileges can lead to unrealistic expectations and potentially disappointing results. So, what's the takeaway? Instead of attempting to follow Buffett's exact steps, focus on adapting his principles to your own situation. Invest wisely, but recognize your own limitations. Be disciplined, but stay flexible enough to adapt to life's changes. And remember, true success in investing isn't about copying someone else's journey, it's about finding a path that works for you. If this perspective gave you new insight into investing, don't forget to like, comment, and subscribe. Let's explore more strategies that make sense for real, everyday investors.